Hello, Professor Eisenmann. Thank you so much for your time today. We really appreciate it. I thought it would be really interesting to hear your perspective on startup failure. Would you like to introduce yourself?
Yes, hi, I'm Tom Eisenmann. I'm a professor at Harvard Business School who teaches and studies entrepreneurship.
That's great. That's great. So let's get started with the questions. Out of the 6 distinct reasons for startup failure that you highlight in your book, which one do you think is the biggest one?
Well, without question, the false start. So the 6 reasons, 6 causes of failure patterns. 3 are subject to early stage failures, and 3 are later stage startups. The false starts simply because there are so many more early stage startups than late stage startups, because so many startups fail along the way. If you look at the #1 killer of startups, it's going to be an early stage pattern. And the false start is essentially when an entrepreneur so eager to build and sell the product they've envisioned dives in without doing enough upfront research to really prove that there's demand for their concept and to validate that the solution they've got in mind is the best of the possible solutions. So eager to get going, they've skipped a few weeks of upfront research. And as a consequence, sometimes the first version of their product will hit the mark, but more often, if you've skipped that research, you'll miss the mark, and it'll take, 4 months to design, build, sell, and then figure out what's going wrong and what to do differently. And so you've wasted 4 months when you probably don't have that much capital or time in order to save 4 weeks of upfront research. It's a bad trade.
Interesting.
So we call that a false start, just like in track and field or swimming, when the athlete jumps the gun to get an edge, but gets penalized.
Got it. I love the parallel with track and field and sports. And you're right. I think false start does set a startup up for failure to some extent because of haste and lack of research. Thank you.
Yeah, and it's very understandable. I mean, an entrepreneur wants to make things happen. We have the image of an entrepreneur who just do it. That's sort of a Nike motto. So many entrepreneurs are sure they can see around corners and see the future. So why do the research if you're positive that you found a problem and the right solution for that problem? And it's also true that a lot of readers and listeners would be familiar with lean startup logic, sort of get a product out there as fast as possible and get customer feedback on it. And that's actually really important. And entrepreneurs who are subject to a false start may think they're actually following lean startup logic by testing a minimum viable product. In fact, they're doing the back half of lean startup. The front half, which Steve Blank talks about, is get out of the building and do interviews and validate demand before you start the engineering work. So engineers love to build, entrepreneurs love to make things happen. So it's a pretty natural impulse. I would say even the non-technical founders that I work with, and there are a lot of them in MBA programs, they hear over and over again that to succeed as an entrepreneur, you need great product. How do you get great product? You need a great engineering team. How do you do that if you're non-technical? You use the networking skills that you're so good with as an MBA. So they find a co-founder, or they scrape together enough money to outsource the development or hire a first employee. Once that engineering team's on board, you have to keep them busy because they're expensive. And what do? They build. So you start building before you've really validated the design.
Got it. That makes sense. Thank you for the thorough explanation. So I was wondering, through your methods, have you been able to implement your techniques to prevent startup failure?
Well, I think it'd be arrogant to assume that that I can take credit for anybody that was sort of steering off a cliff and sort of made a sharp turn to save themselves at the last minute. I hope that's the case. I mean, I've heard from, and the book's only been out for essentially since March. So less than a year. But I've heard from a lot of entrepreneurs that either it shed light on what they had done wrong, or they plan to change their action plan. So I hope it's the case, but no, I honestly can't point to a specific instance where this was the rescue.
Got it. And it's nice to hear the positive feedback. So I was wondering, Silicon Valley thrives on placing startup founders with big visions as demigods, but you talk about big vision as a reason for failure, tying back to the first question, but why?
Well, I mean, a founder, an entrepreneur, is doing something new with limited resources. That's the very definition of entrepreneurship: is doing something new with limited resources. And something new is by its nature risky, and it's even more risky to try something new if you don't have a team, if you don't have access to distribution channels, if you don't have the partnerships you need, if you don't have money to move forward. So you need a vision, and a great entrepreneur is going to be a great storyteller, because they need to persuade team members, co-founders, investors, customers, strategic partners to come on board. And great storytelling requires a vision and the passion that people will perceive when they hear the story, and it gives them the confidence to follow the entrepreneur, to contribute their time or their money to the venture. So vision's crucial for every entrepreneur. Where it becomes dangerous is where the vision is so strongly felt that the entrepreneur can't read signals from the universe that their idea is flawed. It's time to reconceive the vision, try to think of something new. And it's very natural human response, ego defensive response, to ignore, to sort of filter out signals that tell you that you're on the wrong track. So it's easy for an entrepreneur to be very stubborn, and we tell entrepreneurs they need to be persistent, right? So yeah, it's not working, but we just need to try one more feature, or go make the sale to one more customer, or pitch one more investor on giving us the money we need to keep going. So it's a really tricky problem, because an entrepreneur needs confidence, they need vision, they need to be persistent, but there is a point for all those things where going too far can keep you on the wrong track too long, and keep you from changing direction. And that's where vision becomes a cause of failure.
Yeah, I strongly agree with your points made. One, the fact that startups, entrepreneurs need to have foundational skills and do their research properly, as well as, develop a good skill of storytelling, because that's extremely important for pitching to investors. And yeah, thank you for sharing that. For the next question, I thought speed is the currency of startups, but you call hyperspeed something that can cause disaster. Like you've explained before, are there any other reasons why?
Yeah, so again, this is a tricky one, because entrepreneurs love growth, investors love growth, everybody loves growth, and it's the the Paul Graham at Y Combinator would say that sort of growth is, as you say, right at the core of being a startup. A startup is a young organization that wants to and needs to grow, but it is very possible to grow too fast, and to grow in a direction that will be chronically unprofitable. So it's often the case that the first customers for a new venture are foaming at the mouth early adopters who really want what the entrepreneur has, and will spread the word, and repurchase and so forth. But unless the next wave of customers, the mainstream customers, have the same needs and the same strength of needs, it's going to be harder to acquire the next wave of customers. And so to sustain the growth, you may have to reduce the product's price, you may have to market harder. If you do manage to bring the customers in as the organization starts to grow, if it's pure software, it may scale gracefully. But if you have humans doing anything, answering phones, packing things in a warehouse, then you got to hire those people, and you need management systems to train them and supervise them and coordinate their activity and so forth. And this is all done in a startup that had none of that to begin with. So you got to hire, you got to maintain the maintain control. And if you go too fast, you can get into the squeeze where customers are worth less because they're less likely to stick around. They're less likely to spread word about the product. You had to spend more on marketing to acquire them or cut the price of the product at the very time when your operations may be wobbling because you're growing too fast. The company's culture the startup's culture can come under pressure. So the first set of employees are close to the founder. They believe in the mission. The next wave for those folks, it may be just a job, and the old guard resents the indifference of the new guard. The new guard looks at the old guard, and if those stock options are valuable, like why is the person in the cubicle next to me sitting on $3 million worth of stock options when I'm just drawing a salary? The new guard tends to be specialists in their functions. You need somebody to run community relations. You need somebody to track the inventory in the warehouse. The original employees were generalists, jacks of all trades, who could sort of jump in and fill any role as conditions required. And so you can get old guard, new guard conflict. You get conflict between specialists and generalists. So culture wobbles, operations wobble, the profitability of customers wobbles. And at some point, as long as it's growing, the new investors may come in and old investors may put more money in. But at some point, people look at the situation and say, this isn't getting any better. And when it goes bad, it can go bad very quickly. And if you're burning cash at that point and you've burned through all your capital and you can't raise more, companies can fail very, very quickly. So ironically, even scaling startups or startups that have made it through infancy in their teenage years can struggle and die when they get more mature.
Got it. Makes sense. And, in general, I just wanted to thank you for talking about startup failure, because, it's kind of also somewhat a taboo when people are creating companies in the Bay Area and Silicon Valley to some extent. Of course, it is talked about, but people really do feel that it's not worth attention or worth time. And, I think, I believe it was Reshma Sajani or somebody had said this quote, like, in Silicon Valley, to be taken seriously, you have to have at least one failed startup or something of that sort. So, I mean, we could probably, she's probably through your book and through your words of wisdom, I'm pretty sure you could help change that.
Yep. Well, it's, depending on how you count, when you start counting, for venture capital backed startups, something like 2 out of 3 don't make money for their investors. And, if you're a serial entrepreneur, the math is pretty simple. If you do 3 startups over the course of
you learn something.
Career, yeah, the chance of having 0 for 3 is pretty high. And the chance of having at least one failure is very high.
Absolutely. I was wondering, can you create like a mathematical formula that can predict a startup success rate, by quantifying attributes of founders and investors, for example?
Yep. A lot of people have tried this. There's a lot of data out there. So the assumption is if you sort of pour all the data into a statistical model, whether it be a machine learning model or just straightforward econometrics, turn the crank and you should be able to predict based only on things when the entrepreneur is just getting started, their background, the market they're targeting, what the competition will look like, so on and so forth, that you ought to be able to predict success and failure. So I tried that. The appendix to the book presents the analysis of a survey of 470 early stage founders. These are folks who launched launched a startup between 2015 and 2018 that raised at least $500,000 and no more than $3 million in their first round, and excludes science-based businesses. So it's mostly software-based stuff. And I asked these founders, 50 questions about who they were and what the business was doing and how they were managing in the first year of the business. And so there are some variables that are predictive of statistically significant predictors of success and failure. I was able, so by stopping at 2018, if I did the analysis in 2020, 2021, I had a few years to sort of see how the venture was evolving, whether it had failed or was trending toward failure because of down rounds and so forth. Failure to raise new equity at a higher share price than the original equity. I would say that the things that I think folks would assume are highly predictive are not highly predictive. Things, attributes of the founder, sort of where they went to school, do they have an MBA, gender, age, or were they a serial founder? Nothing really moved the needle in a few of those variables viewed alone, one at a time, are significant. But when you put them all together into a model, which is the right way to do it, a multivariate model, none of that stuff, none of the founder attributes emerges. The only predictor that was statistically significant when sort of doing the statistics properly, a multivariate econometric model, was the number of late stage rivals you faced. So, basically what that says is you don't want to launch a ride sharing service if Uber and Lyft are out there, sort of not surprisingly.
Happily over the market, doesn't it?
Yeah. So, but overall, these models are you can explain some of the variance in outcome by throwing all the variables in, but I would say if sort of folks are familiar with the concept of an R squared, the sort of fraction of the variance you explain, the R squared is low. It's on the order of 20% of the variance you're explaining. There's a whole lot of other stuff going on. So for anybody who thinks that they can invest as a VC by turning the statistical crank, maybe they're better statisticians than I am, but I wish them luck.
Okay, yeah. I would like to especially thank you for the point that you made that, I found it really interesting, the fact that, having an MBA from a certain school, age and gender doesn't really move a needle in startup success rate. Because, my first book, The Young Aspiring Entrepreneur, I published it because I wanted to write about the age and gender biases that entrepreneurs face. This was just observing my entrepreneurship club in school that I had kind of pestered my middle school to create because DECA, which is for high schoolers, it was not available for the younger students. So I found that really interesting that, age, gender, and somebody so, learned and experienced. It's really,
so I should draw a distinction between becoming an entrepreneur and the barriers to doing that, which, clearly there's a gender bias in terms of who gets the opportunity to be an entrepreneur. But once you have the opportunity, at least in the data set that I have, gender didn't make a difference. The women were just as likely to fail or succeed as men.
That's interesting to hear. Thank you for pointing that out. Moving on to my next question, can artificial intelligence predict a startup success rate from an unbiased perspective? Because, the whole idea of ethical AI. Yeah.
The problem that we're all concerned about with AI is you train the models based on historical data, and historically, an awful lot in the startup ecosystem is biased toward a certain kind of founder. There's gender bias, there's bias against underrepresented minorities and so forth. So, so in the first place, I don't think AI or machine learning can predict success. In the second place, if it did, it would probably tell you to go find, a 25-year-old white or South Asian or East Asian male who's a computer science major from Berkeley or something like that. It would point in the future to past success, and and by the way, the 25-year-old isn't necessarily the way to go. That, you know, to the extent other people have looked at age and would basically say the older the better, and there's logic for that, right? So, sort of older folks have richer networks and more experience, and so on and so forth. It's not in my data set, but other people. And remember, I only looked at early stage startups. So people who've spent more time looking at this would say if there's any age propensity, it's older is better.
Interesting. I mean, to some extent that does make sense. Like you said, higher network and probably more experience, and probably not ones to make haste to some extent.
Yeah, and other things. I mean, it takes a tremendous personal sacrifice to be an entrepreneur. So the good news is if you're 20 years old and not married and you don't have a mortgage and you don't have kids to worry about,
Financial
you can take risks. And if you're 45 and you have all those things, sort of a family to support, you may only take the plunge if you're pretty sure you've got a great idea. So it could be that the success of older entrepreneurs has to do with appropriate risk aversion.
That makes sense. There are probably other like lurking variables involved as well. Absolutely.
Yep.
I was just curious. This is just another question I thought of. Do you think ethics and unethical decisions have played a role in startup failure from your experience, or other data sets, etc.?
Oh, no doubt about it. The slippery slope when you start to get in trouble as an entrepreneur is there. I mean, every entrepreneur at every step of the way has to make ethical decisions about the representations they make. Right, they're constantly selling, and they're selling usually nothing, a vision, and it's always tempting to misrepresent the progress you're making. Sort of we're further along, and so the pressure is only that much greater if you're running out of money. If you have to raise money to talk about the progress you've made. Yeah, so that's. Every entrepreneur, lying is an occupational hazard, and it's especially a hazard when
We've
you're
seen that with Elizabeth Holmes, for example, recently.
Totally.
There's like an extent to which you can exaggerate the numbers.
Yeah, fake it till you make it is celebrated in Silicon Valley, and there are ethical ways to fake it and less ethical ways. So
absolutely. No, yeah. I mean, I created like a simple rudimentary formula in my book in 8th grade. That's just, it has different factors like number of customers, the revenue created, and one is ethics. And it's, 8th grade me, 13-year-old me found it really simple to just put ethics in there. But I think quantifying it and actually being able to properly measure it, because it's such a subjective thing. And, like definitions of ethics and morality vary per person. So yeah, I was just curious to get your thoughts.
And I think the good news is folks who teach entrepreneurship and folks who coach entrepreneurs are way more sensitive today than they might have been 5, 10, 20 years ago to this. And I mean, particularly at Stanford, colleagues there are thinking hard about how to teach entrepreneurial ethics.
Yeah, ethics in business and entrepreneurship. Yeah, I've seen that around like as a distinct subject as well in a lot of colleges and universities. So I think that's like a good starting step, I feel. Now the other thing is if the next generation of entrepreneurs would be able to implement those ideas. But yeah, definitely. Just wanted to say thank you so much for your time today, Professor Eisenmann. And
Sure, Taarini.
I was wondering if you had anything else to add about your book and the platforms in which it's available.
Nope. I hope it's helpful to entrepreneurs. If they just sort of Google my name and the name of the book, there's some excerpts that I think they might find useful. That are out there without, even if they don't buy the book. There's a letter to a first-time founder that I think offers some advice that some folks have found helpful. So have at it.
Absolutely. Thank you so much once again.
Okay, thanks, Taarini.